The short-term rally is on, but is it here to stay? That's coming up. Over the last couple of weeks, we've talked about this potential rally we would have, and yesterday we talked about the fact the market was breaking out of this short-term downtrend that had been building up in the markets over the last 2 weeks. That breakout occurred with some conviction yesterday, sending the market up to previous resistance levels. Now we're back here flirting with where we were at previous highs, so that previous existence is now going to come into effect here. Markets are expected to open up a little bit this morning. Sustainability is going to be a bit more of a question. But in the short term, we've got some good positive events developing. Money flow indicators and MACDs are turning up, heading towards a buy cross here. That would suggest more upside for the markets. That would coincide with this traditional Santa Claus rally. But we could see a little bit of weakness here as we move into next week. We've got the Fed meeting. We've got a lot of other things that are going on. So again, there could be some headlines that present some short-term weakness in markets, but I don't expect any serious downside here over the course of the next couple of weeks as we move into the end of the year. It's possible, but again, with signals turning back positive, money flows improving, we should see that continue. Another indicator that also suggests that we're in the midst of a short-term rally is the volatility index. After spiking sharply over the last 2 weeks because of the sell-off in the markets, it is very quickly collapsing back towards support here as the risk-on attitude is now replacing that risk-off fear we saw in the market previously. Another indicator as well are bonds. We mentioned previously that bonds had gotten very overbought on a short-term basis. In fact, the 10-year Treasury bond had broken above its 2 standard deviation move, above the 50-day moving average. Again, that was that risk-off attitude as money was shifting out of equity, risk-on, into bonds, risk-off. That is now also turned with bond prices now falling back towards the 50-day moving average. That also suggests that in the near term, this rally does have some legs. It doesn't mean that the market's just going to take off and go to all new highs here over the next 3 weeks as we get into the end of the year. It's certainly possible, but it would not be surprising. Markets are back to overbought on a short-term basis. We could see some sloppiness in price action as we move through next week. Mutual fund rebalancing is finishing up here. But as we move in the last 2 weeks of the year, again, these kind of positive buy signals that we're getting should help lift the markets through the end of the year, that traditional Santa Claus rally. Now, after that, we're going to be starting to talk about reducing exposure as we head into next year, because I suspect the Fed is about to become a bit more hawkish in terms of their attitude towards tightening monetary policy at a faster pace. That will impact equities as we get into next year. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.